Good evening and a warm welcome to the second installment of the Rutgers Business School Supply Chain Master Series. I'm Bob Ferlato, and along with my co-host Sunny Nastasi, we're happy to present tonight's topic, Funding the Sustainable End-to-End Supply Chain. And a few words about tonight's topic. The optimization of cash flow for organizations that includes transactions across a broad ecosystem of suppliers and customers is a cornerstone performance indicator for operational and supply chain excellence. And the area of supply chain finance is enabling suppliers and customers of all sizes and in essentially all countries of the world to remain viable and competitive, ensuring liquidity in the vast network of global commerce by optimizing cash flow and working capital and minimizing total cost. Moreover, the use and perfection of blockchain technology as a fundamental element in financing supply chain ecosystems will be transformational. Now, before we get started, let me introduce you to a few folks that are central to this series overall, as well as key to tonight's session. First, I'll mention that my co-host Sunny Nastasi and I will play a supporting role for tonight's session. We'll take a break from actual facilitation, and I'll introduce you to our facilitator for tonight in just a bit. Nonetheless, as background, Sunny is a supply chain expert with a unique ability to drive long-term results and high-performance cultures. She's held leadership positions in Fortune 50 corporate environments, as well as smaller and startup organizations. And she's a board member for the Rutgers Business School's Master of Supply Chain Management program. Sunny, always good to be with you tonight. How are you?
I'm great, Bob. Thank you for that introduction, and welcome panelists and guests as well. We really look forward to the session tonight. Just a couple of key points I'd like to bring to you. First, in the chat feature, you will be able to provide any questions or commentary along the way. And if you have a particular question for a particular panelist, please make note of it. I'll be reading through those Q&A questions for the panelists at the end. Secondly, we are recording this session, so you'll be able to view it later or share it with colleagues via YouTube. And shortly, the YouTube channel will show up in the chat feature. There it is as well. Thank you, Rudy. I'd also like everyone to recognize that we very much appreciate the Rutgers Business School sponsoring this initiative of multiple programs across the season here up until the early spring. And we particularly want to thank the Masters of Supply Chain Management program for these free webinars. So with that, I look forward to hearing what our panelists have to say. Back to you, Bob.
Well, thanks very much, Sunny. I know you'll join me in recognizing Miss Brody Sheldon. Brody is the Senior Program Coordinator for the Master of Science in Supply Chain Management program at the Rutgers Business School. And we're grateful for her valued insight, ideas, and support, and for keeping us all on track as we prepare and deliver this series. Tonight, Dr. Rudy Luschner will iterate between facilitator and participant roles, and we felt this was appropriate as Rudy has in-depth knowledge in the area of supply chain finance. In case you're not aware, Dr. Luschner is Associate Professor of Supply Chain Management, the Director of the Master of Science in Supply Chain Management program, and Faculty Coordinator for Distance Learning Initiatives at the Rutgers Business School. Dr. Luschner has co-authored a book on supply chain finance entitled Supply Chain Financing, Funding the Supply Chain and the Organization. Now on next to our valued panelists for tonight's discussion. Sam Bisri is the founder and CEO of Zeconomy, a blockchain banking-as-a-service solution to enable businesses to lower costs and gain more financial freedom by banking themselves. Prior to founding Zeconomy, Sam was founder and CEO of CodeHost, a provider of print solutions to the world's leading print brands who licensed and installed it at over 50,000 locations worldwide. In addition, Sam built quantitative finance models with Principia Capital, which consistently beat hedge fund peers and index averages. And he holds many patents in the fields of finance and technology. We also have Jeffrey Thompson on our panel tonight. Jeffrey has worked at Merck for over 4 years and is currently the Director of Payment System Sourcing and Strategy. He's been working in procurement, sourcing, and finance for over 15 years. And finally, Luca Gelsomino is with us tonight as well. Luca is an assistant professor at the University of Groningen and the academic director of the supply chain finance community. In this role, he oversees the community's research projects, international network, and publication strategy. And so with that insight, let me turn this evening's panel discussion over to Rudy. Hi, Rudy. How are you doing?
Doing well, Bob. Thank you so much for the kind introduction, and thank you so much for all of our panelists, participants, and hosts for joining us. And I'm going to lead right into this, and I will ask Luca to provide us with a little bit of a background on supply chain finance. What is supply chain finance, Luca?
Hi, thank you, Rudy. Happy to be here, of course. So supply chain finance, indeed, for the one among you that might not be familiar with the topic, it's a relatively straightforward concept. Broadly speaking, it has to do with managing the financial flows across supply chain, but at very pragmatic and practical level, if we want to keep it simple, it's just a straightforward financial arrangements by which a large and usually very creditworthy buyer, Walmart, Philips, Procter & Gamble, IKEA, whatever you want, works together with suppliers and financial institutions to support financial access to liquidity for suppliers. And practically speaking, what happens in most cases is that such a buyer would go to their own financial institution and would say, okay, I have this set of suppliers that I am connected to, and whenever a supplier issue an invoice to me, I, as IKEA, as Walmart, will give the financial institution a sort of confirmation that this invoice will be paid by me in 60, 120 days, 30 days, 90 days, whatever payment terms are. With such a confirmation, then the supplier will be able to get the invoice paid right away in a matter of days, usually 2, 5, 10 days by the financial institution right away at a very, very low cost, because the cost, of course, is driven down by the fact that the bank has a confirmation that the invoice will be paid by a large creditworthy buyer. In this sense, then, the supplier gets the invoice paid right away in a matter of days at a low cost, while the buyer does not have to pay right away and can pay with ease 60, 90 or 120 days. And therefore, we call this a win-win approach for supply chain finance, because on one side, the supplier gets paid very quickly, the buyer doesn't have to pay right away, can even extend payment terms, and the bank can facilitate, let's say, this intermediation between buyer and supplier. And on paper, therefore, if everything works well, we have this nice effect by which suppliers get paid very fast, buyers can pay later, and this creates value for the entire supply chain. As such, this specific supply chain finance approach has taken up a lot in the past 10 years, and it is now very much of a standard both in Europe and in the United States and in some Asian countries, to the point that roughly half of the largest corporates in the world have such a program up and running with their own suppliers as a way of creating value for them and themselves by optimizing and improving the management of their working capital. There are other approaches, of course, and I would say in the past 2 to 5 years, the sustainability angle related to supply chain finance. So the idea that in this mechanism of facilitating early payment of invoices for suppliers, the connection with specific sustainability angles For example, facilitating specific suppliers or facilitating suppliers that have a specifically high sustainability performance has picked up as well, to the point that today we have a lot of discussion going on the side of sustainable supply chain finance or supply chain finance for supporting the sustainable performance of large brands. But of course, I don't want to go too much forward, and I'll leave it back to you, Rudy.
Thank you so much, Professor Luca. That was a great introduction. And that actually leads us into our first question. How does supply chain finance contribute to supplier development and a more sustainable supply chain? I want to kick that question off to Jeff. So from your perspective, what does supply chain finance offer towards sustainability?
Yeah, great question. So, I think the traditional use, as Luca was talking about, traditionally, buyers look at supply chain financing as an opportunity to improve their own payment flow. At Merck, we very much, one of our core objectives is to have our supply base reflect our base of patients. And that means, we want those diverse suppliers. We're always looking to increase the diverse supply base. In addition, we also have an obligation as a federal contractor to do a certain amount of business with small suppliers. So to that end, we see this as an opportunity to make it a little bit easier. We recognize that it's difficult for a small supplier to do business with a large buyer. It's not equal footing in most cases. It's very difficult even just to onboard with large suppliers due to the obligations from contracts, obligations, setting up just vendor master files, and that's even before we start negotiating terms. So if we have a supplier that is performing, we want to be able to offer this product as a way to enable that supplier to do more business with us. And the way that they can do more business with us is by having a more flexible cash flow, and a cash flow that we're not dictating. So that's what supply chain financing can do for the supplier. It can offer them the ability to, take their cash whenever they need it. And maybe that's not, within 2 days on every invoice. Maybe that's 2 days at the beginning of the month, and maybe, in other times, maybe they'll let it go a little bit further. So that's kind of the entire idea, is to add that flexibility, give the supplier more control, enable the supplier to do more business, and hopefully make us a more attractive buyer for that supplier.
Wonderful, thank you, Jeff. So, Luca, since you and the supply chain finance community pretty much has visibility into all kinds of different arrangements, what would you see as different approaches towards the goal of sustainability? What have you seen so far?
Yeah, indeed. So I would say that the connection between supply chain finance and sustainability is something that came up around 2015, 2016, when the International Finance Corporation within the World Bank Group started to think along this line with some of the largest fashion brands in the world. And they said, well, okay, since you are already paying facilitating payments to suppliers early, why don't you introduce a penalty or a bonus depending on the supplier sustainable performance? That was the beginning of this idea of linking together supply chain finance with sustainability. And I would say today, this has already become quite a large idea. A lot of large brands, including Henkel or Bridgestone or large brands everywhere in the world, have this program, and this has been linked already to a lot of different flavors. So, for example, I would say in Europe, there is a lot going on around decarbonization and mapping scope 3 emissions. So, for example, the idea is I can support you as a brand in incentivizing suppliers to provide information that help you measure Scope 3 emission. So if a brand has difficulties in getting information in that sense, financial incentives can be a big thing. On the other side, we also have diversity, equality, inclusiveness. So for example, the idea that you can facilitate access to liquidity for more minority-owned suppliers, or let's say other type of supplier class that increase diversity in your supplier base. But I would say what is maybe the most interesting approach right now is to link the concept of supply chain finance to low-income countries, and use supply chain finance as a tool to facilitate access to liquidity in low-income countries and connect low-income countries to more high-income ones, through the idea that you can improve working capital by just giving this payment undertaking, this confirmation of invoice. But this, of course, is a much bigger discussion that goes a little beyond the idea of account payables and approved payables financing, and goes more in the direction of extending financing across supply chains.
Thank you, Luca. That's a very good explanation. So I think there's a lot more to come. And the last time we were together in person, we also heard the World Economic Forum having a lot of interest in that topic. So moving ahead, what should we expect? And I want to turn it over to Sam. And what do you think from your perspective, running a financial technology company? What are the big challenges?
So, well, thank you for inviting me to the panel in the first place. So I appreciate it. But to start basically with the changes in the economics picture around the world, from interest rates going up to liquidity shrinking, to the risk associated with the different political winds that we're seeing around the world. So there are challenges to both basically global trade, global liquidity. There is increases in risk significantly on global transactions. At the same time, even within the local economy, there is inflation, and there is the increases or the sustaining increases in interest rates that are happening today. All of that is going to lead to a lot of shrinkage of available capital that we basically enjoyed over the past 10 years. It's been very easy to basically put programs together and deliver value to suppliers over the past few years, given the access to cheap liquidity or cheap capital. So today, all of that is changing, and there isn't very clear visibility as to what's happening next. Like what kind of potential recession could happen, what kind of effects can happen on the smaller suppliers, basically, or deeper into the supply chains or the international supply chain overall. So we need to find a lot of answers. We're working on some answers on our part to help large corporations find these answers. But there are a lot of challenges that surpass improvements that we were looking at in the past couple of years.
Thank you so much, Sam. So from your perspective, Jeff, what would you say the big challenges going forward are as you're starting to grow the Merck program?
Yeah, I think for the most part, the biggest challenges are, trust and education. So, as I socialized, this potential opportunity with a lot of the small, diverse supply base, a lot of the feedback was that, they associated a supply chain finance program with extended payment terms, because that's a traditional use. That's traditionally the approach for most buyers. So automatically there was that, that initial reservation about having those conversations, because they assumed, rather than presenting it as something of value to the supplier, it was a means to longer payment terms from the buyer. So there's that reservation there. There's that history of that experience that hasn't really been always positive. But I think part of that is also due to the education. So we know that in a lot of these small suppliers, there's people wearing a lot of different hats. So there's not a dedicated treasury department. There's not a dedicated CFO in many situations that we can sit down with, who's seen this program, who understands this program. So it's going to take, in many circumstances, a lot of conversations. It's going to take, a lot of those whiteboard sessions, just kind of sketching it all out and saying, this is what you can do. This is how it's a win-win situation. I think that's from my perspective, that's really the biggest obstacles I have is the trust in the education.
That's very interesting, Jeff. And quite honestly, I can see sort of both sides of it. And these are similar challenges that I've heard a good friend of ours, Doug Schock at Siemens, present in 2015. So yeah, 7 years later, it's not surprising. Luca, from your perspective, what would you say the big challenges are right now?
Yeah, I think both answers were quite refreshing to hear, because they show how the view and how the situation around supply chain finance has changed over the past years, especially the past 2 years. I think that I completely agree, especially with Jeff. Before the pandemic, supply chain finance was very often, and maybe too often, just a payment term extension machine for large brands, for large buyers, to kind of get a bit more out of their working capital, out of their buyer-supplier relationship. I would say now the framework has changed. And if you ask me what are the challenges today, I would say it's mostly about linking supply chain finance with supply chain management goals, and using supply chain finance effectively from a supply chain management perspective. So today, I personally, as supply chain finance community, and me personally, we have much more conversation with supply chain management people involved with supply chain management on how can supply chain finance drive value for the supply chain. That is linking supply chain finance with supply chain resilience, for example. So what is the role of such a tool within my resilience strategy? What is the role in such a tool in linking with critical suppliers, in building capacity and flexibility? I think this is probably the #1 challenge, defining and understanding the role of supply chain finance in the broader supply chain management discussion, and moving it a bit out of the traditional trade finance role that it had up to 2019. And I completely agree with Jeff. It's about education before than anything else. So that's a wonderful answer.
Absolutely. And I think we also have to remember that the last 2-3 years have done a lot. And I don't know if Sam can comment a little bit how the supply chain disruptions during the pandemic have driven a lot of demand for some of these tools.
Yes, so there have been new innovations that are coming to market, and some of them to deal with some of the limitations that exist in supply chain finance. So for many companies who are basically players or issuers in the supply chain finance field, the limitations have been from the complexity that Jeff mentioned to the limitations with their existing financing with their banks, because in supply chain finance, you need to get like carve outs, which is called like excluding the invoices that are part of the supply chain finance program versus the ones financed by the bank that are not part of the supply chain finance programs. And people expected a lot of the individual small suppliers to handle that. And that's a tall order sometimes for many of these small companies to be able to manage that. At the same time, right now, with the changes of interest rates and changes of focus that is happening, many of these corporations are looking for alternatives to grow those benefits, to grow that liquidity into the supply chain. So one of the things that we're doing basically is to enable this view of a, sort of like acting as a supply chain finance bank into the whole supply chain as a network rather than individual transactions from an individual buyer. And one of the things that Zeconomy basically is trying to do is to enable large corporate customers like like the Mercks and the Siemenses of the world to be able to basically not only just offer credit support to invoices that require all of these transactions with the banks, et cetera, and the complexity, but to actually use their own credit to directly back payments and use it as payments into the supply chain and enable suppliers to directly access money market liquidity, basically at the end of the day. And that required like new technology and new understanding of technology such as blockchain technology as one of it. But that made it very simple also for people like suppliers to be able to adopt it because they no longer need to go through this complexity of trying to get carve-outs from their bank, limited to just the single transactions basically with the single anchor customer. And we can talk a little bit later about broadening it beyond the first tier of suppliers as well.
So let me just ask you, because I always have to ask this question of people who decided to start now 2 companies. What was that little nugget that you saw out there, or what was the driver for you to say, you know what, I have a business idea, I'm going to start this company and it's going to solve this one problem? What was it? I have to ask.
Yeah, so it actually, the initial idea grew from the financial crisis that occurred. As you mentioned, Bob mentioned CodeHost, for example. At the time I was running CodeHost as well. And many of my customers basically had problems paying their bills during the process. And they are all healthy companies. They had good cash flow, good margins, et cetera. But part of the problems that they faced is that their credit lines dried up. So sort of like the banks came back and said, okay, the money you drew is okay, but the money that you still have and can withdraw, you can't withdraw anymore. And it's not the fault of the company, it's the fault of the bank at the time. So sort of like saw that it's not only banks that take credit risk on the companies they lend to, but actually companies take credit risk on these banks. Which is another challenge sometimes in the SCF market, is that if you have disruption to the banking system, you could have major disruptions to your own supply chain rather than having the diversity that exists without a program sometimes in place. So that drove the first idea, and that became like my first patent is, can we actually drive liquidity between healthy companies without the need for these credit lines and the restrictions on these credit lines? And that came the idea of basically aligning cash flow and cash flow offers deep in the supply chain with different suppliers that morphed into what we're doing today, which is using blockchain and enabling that to actually happen with full transactions being done on the blockchain that makes things easier. But the main thing is the fact that how unhealthy banks could destroy very healthy supply chains and companies. That's basically was my first view of this.
That's fascinating. So speaking of the technology part, obviously, Jeff, you have to collaborate with your IT department. And technology was one of the barriers at some point in implementing some of these programs. Where do you think we are today?
So I think the biggest obstacle is really, those IT guys are very popular. So, just getting their time for the project is probably the biggest challenge. The integration within SAP seems fairly straightforward. Any of the large corporates that are using, a large invoicing platform, it's updating the vendor master and you're good to go. So on the buyer side, I think the technology is there. It's fairly simple. It's just, competing priorities, I think, is the biggest challenge.
Do you have any visibility into your supplier organizations? Is it a heavier lift for them, or about the same?
I think it's about the same, but I think that's more provider specific. But I think it's, for the most part, there's that dashboard that they go in, they decide, do I want to take, early payment on invoice 1, but not invoice 2? So it's all very straightforward. I think it's just a matter of, once they figure out how to use it, it's that simple, or it's fairly simple.
So Luca, from your perspective, where do you think this technology stands?
Yeah, what I see, what I perceive from the market, from the SCF industry right now, is that technology is really not a key obstacle anymore for supply chain finance programs, in the sense that if you look at the modern supply chain finance program from any provider, whether it is a bank provider or a fintech provider, it's really optimized to the extreme. Just to give you an example, one of the largest providers in the world, Taulia, has merged with SAP, which now means that they can probably provide supply chain finance already embedded, or they will in a couple of years provide the supply chain finance already embedded in an SAP. But even if you go with any other provider, what I hear from corporates is that the technological aspect is really not the obstacle. I think that the key challenge is maybe linked a little bit with what Sam said, is to extend the idea of supply chain finance, not to the single buyer-supplier relationship, but to the concept of the network. And that is indeed a challenge today, because it requires quite some development. Personally, my view on that, even though I don't do this on a daily basis, I do research, so maybe we should hear it from the others, it's that the technology itself is not the problem, but what I see as a challenge is finding a driving value proposition for extending supply chain finance to the network level. So moving from extending payment terms with some suppliers to a network approach. Okay, how do you bring the buyer together with you on that journey? What is the value for the buyer? What is the value for all the parties involved? And how do you make everything work so that all the stakeholders are committed to work on a much larger scale of a program rather than a traditional buyer-supplier, supply chain finance kind of things? That I see as the big challenge.
And it is very simple if you stick with the original idea, because it's one invoice from a known buyer to a supplier, and we care or maybe not care who the supplier is, but we know the known buyer and they approve the invoice, and it's a fairly low risk proposition. But now, as you're talking about extending it into the supply chain, so Sam, that is something that your company does.
Yes.
And what challenges does that add? How would that even work?
Yeah, so definitely there are always challenges in education and in bringing the large anchor into the mix. But one thing to remember about supply chain finance is that even though it's widespread, it's still a small percentage of the large enterprise spend. And part of it is because the challenges that Jeff basically presented as well, which is the idea that at the end of the day, some people may look at it as a one-sided solution. In other aspects, it's still not cheap enough for a lot of the participants in the supply chain. So you have segments of suppliers that have good credit, that don't need your credit difference in order to give you extended payment terms, and view the extended payment terms as maybe a high risk for them, given the fact that interest rates may change and all of a sudden now I'm not saving anymore, I'm actually paying more on my cost of capital overall. And then you have the segment that actually doesn't have economic incentive to participate, either not enough volumes, where this is too much taking out of their time and effort, and they're, sometimes they're being offered different programs from 5 different companies, and they have to support each one independently and ask their bank to still bank them at the same time. So all of these are barriers that can be reduced for the anchor customer, for the large enterprise, to expand their supply chain finance benefits in the supply chain by helping these suppliers get more benefit from their suppliers or from basically on their other receivables if they have to. And the way it happens is it's basically, like with us in some ways, is that we do connect, for example, the ability for the tier 1 supplier to basically get cheaper money to pay his tier 2 supplier than to get cash into his bank. So it's a matter of incentives of where can we save to give economic incentives for money to flow faster and deeper into the supply chain. So this is one factor basically, which is the idea that can I get cheaper money to pay my suppliers versus cheaper money to pay my bank or to pay my own internal staff, for example. So what that does, it not only incentivizes the tier 1 supplier to pay the tier 2 supplier in this case, but also it can create the liquidity and the cash flow alignment to the tier 2 supplier, which may make his financing cheaper as volumes grow in this aspect. So you don't have to make major disruptions and replace major programs to do that. Because as we mentioned, for example, a company spending $50 billion on COGS, having that affect another 8% of its suppliers or 10% of suppliers has huge implication in terms of savings for them and for their suppliers. So small differences as adoption grows could mean a lot for the large enterprise for them to pay attention to this.
And I think it's also important to remember that, at least in the developed world, Western Europe, North America, parts of Asia, we have a very well-functioning credit system. It's a credit-based economy. If I want to buy a house, I can, given the right financials, I can go to a bank, get a loan. But other parts of the world are not credit-driven. They are debit economies. And I think Luca mentioned it earlier on. If we're trying to do business with that part of the world, extending credit, extending earlier payments to them is becoming more and more critical. So can you talk a little bit about how some of these things work in non-developed or developing economies?
Is that to me?
Yes, Sam.
Yeah, okay.
Because I still see you're unmuted.
So one of the things that our use of blockchain or our use of the technology that we're doing is to enable basically the large anchor customers to put some of their assets like commercial paper or something like that on the blockchain, similar to like having a bank account on the blockchain. And that will enable them to actually not only do the guarantees that are needed on a global basis, where any global institution can have access to it without having, sort of like some of the regulatory geopolitical risk on how to get that money and how to spend it. and their ability to basically pay anyone with the added benefit of not having the same risks that they take today on individual, credit risk on individual banks around the world. All of these friction points that exist today, blockchain in the future can solve. It's not solving it today. We're trying to get it there. There's a lot of barriers that we're getting through. But the idea is that there is this almost like a structure of multi-tiers of banking systems that need to pass through in order to give credit to a third party. And that is not only related to credit risk, but it's related also to KYC, to regulations, to the AML, to all of that stuff. So even having easy access to pay someone through blockchains today or through other means today still presents a barrier, because a bank may not be willing to lend money to someone healthy abroad because they can't even guarantee that this is the same party they're lending money to, or how to recoup and recover that money. Now, if you put stuff on the blockchain and I can actually touch that asset and lend against that asset, touch that receivable and lend against that receivable without having to go after you in your own country or your own domicile, it changes the ability to provide liquidity from the developed world to the developing world. And that's what we're hoping that the future will hold, is this access that can be global and can really benefit not only the developing countries, but also benefit the large enterprise customers by reducing their credit risk, their cost of transactions, and basically allowing them to reach anyone, anywhere in the world without having to have deposits at risk as well.
Thank you, Sam. That was a great explanation, and it makes so much more sense to me. So Luca, what have you seen in terms of internationalizing supply chain finance?
Yes, I think this last answer from Sam was quite enlightening, because it gives a perspective of what is happening right now in the supply chain finance market, or at least the trends that I think are the most insightful in the supply chain finance market right now. I do see a trend towards making supply chain finance truly a global industry by going beyond approved payable financing, by going beyond the idea of financing the invoice of specific suppliers. That is the concept, of course, of extending it to the network, extending it beyond tier one supplier. And I see today that a lot of large brands, a lot of large buyers are looking into this idea. Yes, sometimes linked to blockchain, but I don't think that's the most relevant point. The most relevant point is that there is sometimes the willingness to extend this idea of early access across the extended supply chain. Of course, this is easier said than done, because it is a relatively complex idea to execute, and it's very powerful. So I see, for example, programs coming up here in the Netherlands that have the aim of tracing supply chains and flow of information, invoices, the physical flow down to low-income countries, for example, in Africa or in Latin America, and by tracing invoice after invoice, by tracing order after order, to go down to the level of the single farmer or the single micro enterprise in a low-income country, to for the purpose of extending credit to that specific enterprise. It's a very powerful scheme, very powerful solution. We are seeing the very beginning of it. It has a lot to do with technology, that's for sure. It has a lot to do with tokenization, blockchain, supply chain transparency and visibility. But if you ask me, this specific trend, the main challenge again is not technology. It's about having a shared value proposition. It's about having commitment from all the stakeholders. So in all the conversation that I see happening around this idea of, let's call it a deep tier financing or financing across the extended network, the biggest obstacle is to find this shared value proposition across all the stakeholders, especially the large enterprises that at the end of the day still play a role in executing such large programs. So I see very promising trend in the sense of making supply chain finance truly global across the world, but I also see an obstacle not in the technology itself, but more on the cultural aspect, let's call it that way, or in the relational aspect of sitting around the table and say, okay, this is the value proposition for everyone. That's how we make this work for everyone. And getting especially buyers on board this idea of extending supply chain finance to the network level.
Wonderful. Thank you, Luca. So let me circle back to you, Jeff. Where do you see supply chain finance going? I mean, you convinced your organization to embark on a supply chain finance program. Where would you like it to see to go? What are your hopes for it?
So, I think supply chain finance has had an interesting evolution. So if you look at, one of the very early innovators in this space, fintech, they partnered with SAP. It was a fantastic product where they would bundle the receivables, and when they bundled the receivables, everything was sold in the secondary market. So these secondary market transactions, a bundle of $1 million bundle of 10 suppliers was not materially different than a $1 million bundle for one supplier. Interestingly enough, though, what happened was, I think procurement didn't really have a lot of interest in supply chain finance. So I think what happened is supply chain finance became almost a bolt-on and a relationship bolt-on between the banks and Treasury. And as a result, what happened was we went from what I saw is we went from a very efficient model to a model that is dominated in recent years by the banks. And unfortunately, the unintended consequence of that is the banks don't really have a lot of incentive to allow those small suppliers to participate because it's in their best interest to sign up one supplier with a very large amount of receivables versus having to manage 100 suppliers. So what I'm hoping, and there's signs of it, I'm hoping we kind of do that full circle and we come around and the fintechs become more and more engaged. Procurement starts to see the value in supply chain financing, and of course, when procurement sees the value in supply chain financing, then there's the pressure for efficiency. So I'm optimistic. I'm optimistic that that will change, and it'll help a lot of the suppliers out.
Thank you, Jeff. So I see the cue from Sunny that we are coming up on Q&A. So feel free to use the chat. Feel free to use the Q&A feature to ask your question. At this point, I just want to pick up on the one question that I see in the chat. So do you see the debacle with FTX and cryptocurrency having blowback or negative connotations for legitimate supply chain finance factors? Is a question that we have. And I liken it a little bit to when we had the financial crisis with the mortgage-backed securities. And that was after that is when I learned about supply chain finance myself. And then when they got to the point of bundling these invoices and creating these derivatives, and where I was like, wait a minute, did you hear about mortgage-backed security that were sold as AAA rated investment vehicles and that whole market crashed. So I don't know who wants to comment on that question, but do you see the FTX collapse as material to this?
Can I maybe give it a go first?
Of course.
Because I feel the urge to answer. So no, I do not see a relationship between the two. Personally, I hope that there's not going to be a relationship, because there is very little connection between the two aspects. So I don't think that cryptocurrencies will have any. They do not have anything to do with the current supply chain finance market. They also have very little to do with the tokenization aspect that we mentioned briefly before. One point that I feel personally very strongly is this: if maybe we should get something out of this FTX debacle, is that in supply chain management, in supply chain finance, we should stop using the blockchain word, because it's not maybe the best from a marketing perspective. It doesn't really matter whether deep tier financing, the network approach and whatever, is based on blockchain or some other technology. And I think it makes it a bit worse. We are making it more difficult for ourselves to talk about the blockchain aspect of deep tier financing, because that's not what drives value. Deep tier financing is not valuable because it's blockchain based. It's valuable because of its value proposition of going deep into your supply chain and financing suppliers. Whether you do that with blockchain or without blockchain, with tokenization, without tokenization, doesn't really matter. What is important is that you drive value with that. So from a, let's say, marketing perspective for the SCF industry, my suggestion is stop using the blockchain word and let's focus on the value driving aspects of supply chain finance innovation.
Sam, I saw you lean forward too, so I'll call on you next.
Yeah, I mean, I definitely agree on the linkage in people's mind between blockchain and cryptocurrency, because that's the only thing that they see is cryptocurrency that have to do with blockchain. For companies like ours and the technology that we offer, of course, all of our technology can exist without the use of a blockchain. So the only aspect was when you get small companies or brand new fintech companies, et cetera, participating. What blockchain presented is the idea that you don't have to rely on this small company or this new company to be your registry of information and data down the supply chain, right? Because you need to have an independent source of data that each one can access, but do not access technically the other people's private data overall, which is a big challenge in supply chains. The other part is you need to have a trusted means for the financial institutions that are taking a shot at funding or being part of the liquidity into the process. So definitely the word can be out. You know, you can say digital and not blockchain. That's not needed basically in the process itself. But ultimately, it does have a direct added value, you know, for the process itself, and that's the independence of data. You know, every software that we sell today or that anyone sells, someone owns. It's about time having a software that is in between everybody and no one really owns at the end of the day. So.
Yeah, of course. I don't mean that we should take blockchain out of supply chain finance. I mean
totally
that
agree.
we shouldn't talk about it. I mean, the point is we are having this webinar online, right? But it's not that we are focusing too much on the underlying technology that allows this webinar to happen. And I think maybe we should take that approach a little bit more also on supply chain finance. I fully agree with you that blockchain drives a lot of value for your solution, but a lot of other solutions in this space. But I think that the value is in the visibility and the transparency. And then if someone has a question, I think you can go into the detail
Yeah.
But starting from blockchain, I think maybe it's not the best strategy right now.
So I see another question from Ozzy in the audience. When you use a third-party payer, do your programs or systems in place, or do you have programs or systems in place to prevent payment of invoices that are incorrectly billed? When you eliminated internal approval process, how do you prevent this?
Is that for me or?
Whoever wants to take it.
So Luca at the beginning mentioned, for example, that supply chain finance requires confirmations from the buyer, basically at the end of the day. So the confirmation isn't just saying that, oh, the invoice is correct. And if, of course, the invoice is not correct, then they have to fix it before they submit it. But the confirmation also says, in many cases, when it comes to supply chain finance, that I'm going to irrevocably pay this invoice, that no matter what mistake there could be on it, if I missed it, Mr. Bank, I'm still going to pay you. So this is how it works with third-party payers, today.
Yeah, so you eliminate the risk of paying invoices that are incorrect through this approval process, and in many industries, it's not really a problem if something goes through that is not 100% correct, because you can always fix it later on. For example, in retail, and there's a lot of credit notes going around. You can have credit notes even within a supply chain finance program. It's not a big deal. You just adjust it on the following invoice or somewhere else. It's not really a big issue.
So
Yeah,
in
the
US,
flow should not.
Yeah. So generally we call those chargebacks in the US, and they're a supplier's worst nightmare, because every time you submit an invoice, your buying company finds something wrong with it. So let me actually get to the second question by Tom. The banks likely charge more for supply chain finance than the cost of short-term working capital of strong international companies like Merck. Why does it make sense to confirm a receivable at an inefficient pricing and just pay the supplier more quickly on the day you would normally confirm it, and then embed it into your pricing from the supplier, like a rebate or something? So maybe that's a question for Jeff.
So if I'm understanding the questions, why don't you just pay earlier?
Yeah.
Why don't you just pay
is that the
earlier?
underlying question?
And the other part of it is, Tom seems to think that supply chain finance is more expensive than other forms of capital.
Okay, so the reason, if as a buyer you're paying earlier, then it's a lose-win situation. It's a lose-win situation because if I'm paying faster, it means I'm using additional working capital. There's additional working capital requirements there from the buyer. The concept of supply chain finance, it should be a win-win situation. As far as the cost, this is something that I'm fairly sensitive about, because the concept for supply chain finance is supposed to be that you pass along, the credit of the buyer to the supplier. But it is true that you do have certain banks that look at the supplier and base the spread on the supplier. So kind of that good enough rate. And that's not a program that we're really interested in exploring. We're interested in that true pass through. We want to be able to, particularly because who we're targeting, we want to be able to give that small supplier the best available rate possible, a better rate than they would be able to get on their own. So that's where the big advantage from the supplier comes from.
And related to that also, we have what we're dealing with is a buyer that has a significantly lower cost of capital than their supplier. So they pass that lower cost of capital down to their supplier. So with that, I'm looking at the time, and I can't believe that we already spent an hour talking about this. So it is time to wrap this.
And I think
let me go back to Bob.
Yeah, I think Sonny's having some technical difficulties, so I'll wrap for us tonight. But first, thanks very much to Sam, Luca, and Jeff. Great discussion, great dialogue on an interesting topic, and something that I think is invaluable for supply chain as we move forward. Just a comment that we'd ask our participants. I think they'll be receiving a survey. Rudy, is that correct?
That's
So
right.
when you get the survey, we really would appreciate it if you'd fill it out and submit it for us. It helps us a lot in setting up future programming. And in terms of our future programming, just a note that we'll be taking a break in January. So there'll be no webinar in January, but we'll start up again early February on Thursday, February 9th. And the topic for that webinar will be around artificial intelligence and machine learning. And we'll have a panel format discussion. I'll lead that one again, February 9th. And then we have others set up for March and April. And we really look forward to your continued participation. We appreciate everybody linking in tonight. And we hope you have a great holiday season. And for those on the Northeast, you effectively bear through the winter months. On that note, Rudy and Brody, Jeff, Sam, Luca, thanks very much. Have a great night. We'll see you in February.